This past week, we saw the single largest day drop in interest rates, with interest rates dropping over 0.5%, as the October inflation report came out and showed that consumer prices only rose 7.7%. So you're looking at this going, interest rates dropped when inflation is still rising and at 7.7%. Exactly. So does that mean interest rates have peaked? Well, that's actually what we're going to talk about in today's video. We're going to talk about the calculations they use to come up with the inflation numbers and why you're likely to see inflation continue to drop over the next couple of months. And as we know, as inflation goes down, interest rates tend to follow. So if you're expecting inflation to go down, does that mean we're likely to see lower interest rates? And how is all of that going to affect the housing market? So this past Thursday, we saw the biggest rally in over a decade as CPI overdelivered. This not only brought the 10-year down, but it also brought the 30-year fixed rate down. At the same time, the stock market went bananas. So is this a short-lived phenomenon or something that we should continue to expect in the future? So in previous videos, when I've talked about the Fed funds rate, I've talked about inflation, I've talked about interest rates, we always talk about expectations, what the market is expecting versus what is actually delivered. And as we've mentioned several times, when the market delivers on the expectations, then the market typically takes that in stride. So for example, if the market is expecting inflation to drop from 8.2% to 7.9%, and the market delivers with a 7.9% reading, then the market takes it in stride and you don't get a lot of volatility. The 10-year typically remains stable and interest rates also remain stable. But this past week, what we saw is inflation cooled more than expected. On a monthly basis, the CPI rose 0.4% in October from September, the same pace as the previous month. The CPI measures what consumers pay for goods and services, whereas the core CPI actually strips out food and energy, and the core CPI rose by 0.3% in October, down sharply from 0.6% in both September and August. Investors and policymakers watch core readings closely as a reflection of broad price pressures and as a predictor of future inflation. So this past week, what we actually saw happen was the market was expecting inflation to come in at 7.9%. It was going to drop from the previous month of an 8.2% reading, and what we actually got was a 7.7% reading, which was 0.2% better than the market expected. And because the market was expecting a little bit more, this is actually a good sign. It shows what the Fed is doing with raising the Fed funds rate is actually starting to deliver, and it's also a sign that the Fed might stop raising the Fed funds rate in the near future and pause and wait to actually see what happens with the market. So the real question is, what happens to inflation over the next couple of months? Well, what I want to do here is throw a couple of charts on the screen. The first one I'm going to throw up on the screen is the overall CPI. Now, what this chart shows is the readings from 2021. And the reason that's important is because every time we get a new monthly reading, the old one falls off. So this past month, we actually got October readings, which came in at 0.4%. But as you can see from this chart, we're actually dropping a 0.9% on that chart. So that's why you saw inflation go down so much in just a month. So as we get November's readings and December's readings, you're going to have a 0.7% and a 0.6% actually fall off. So if you get a monthly reading like we saw this past month at 4%, that is going to show that inflation is continuing to go down. And the same can be said for the core inflation. As you can see from this chart here, the next couple of months read 0.6%, 0.5%, 0.6%, 0.6%. In October, we actually saw 0.6% come off and it was replaced by a 0.3%. That's why we saw core CPI also go down. So if core CPI was to stay the same month over month at 0.3%, if we were to get a 0.3% reading again in December for the November reading, then inflation would continue to go down based on the calculations you see in this chart. So what does that actually mean for interest rates? What does that actually mean for the housing market? Well, before we dive into that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, hit that thumbs up, subscribe to the channel, turn the bell notifications on to stay up to date on everything real estate related. So I believe that if we continue to see inflation numbers go down, move sideways a little bit, do what the market is expecting to do, then I think you'll see interest rates trade in a range. Maybe they'll go back down to somewhere in the 5% range, but you could continue to see them bounce around until the Fed actually comes out with a guarantee that they're going to pause or pivot with regards to raising the Fed funds rate. So with that said, even if interest rates continue to come down a little bit, that might stimulate a little bit of buyer demand in the market. Those buyers that were sitting on the fence, ready to pull the trigger, just waiting for interest rates to come back a little bit, those buyers might jump back in the market. But because there's a potential recession looming out there, there's layoffs happening across the board, and on top of that, it's typically the slowest time of the year to buy and sell real estate, I think you're going to see the market just continue to chug along for the foreseeable future. What that means is you're likely to see pending home sales continue to decline. You're likely to see construction numbers continue to come in weaker than expected, as there continues to be a lot of uncertainty, not just in the housing market, but the overall global economy. And with all of that said, we're starting to move into a political time of the year. We just passed the midterm elections. You're going to start hearing people announce their race for candidacy in the presidential elections, which means that people are going to start use the recession word. They're going to start to blame each other on both sides for everything that's happened, which is going to continue to put more and more fear in the market. And because of this fear in the market, I think you're going to have a lot of people just sit on the sidelines, wait to actually see what happens, unless they truly need to make a move because of some sort of life event. Now, if you're a buyer out there in the market and you're watching what's going on and you're hoping that interest rates are going to continue to decline so you can lock your rate, maybe you're not locking your rate now with the expectation that the market is going to continue to give you better and better rates. I'm going to tell you a story real quick. I was talking to my lender earlier today and I asked him, have you had a bunch of calls now that interest rates have pulled back? And what he said was, I actually got a call from somebody that locked last week, and now they're upset that they actually locked their rate and they want to take advantage of the new market rates. And what I would say with this is, if you're out there shopping and interest rates drop and you've already locked in, you can't be upset with what the market's done. Now, you might be able to shop around, find a better lender, find a better interest rate, get your lender to lower that rate. But in the case that you can't, just be happy that interest rates didn't go higher. What you're doing by locking your interest rate is limiting your exposure to the market. By locking it in, you're giving yourself some certainty. And if you're comfortable with that payment, then I would suggest just locking it and moving on. Don't sit there and watch the market every day after you lock it, wondering what if, I should have waited, all of that. It's a fool's game, and at the end of the day will end up making you go crazy. So if you're in the market right now and you're comfortable with the rate, lock your rate. Don't sit there and play the volatility, play the market unless you have a super high risk tolerance and you understand that it could end up going the other way. While I'm a big believer that inflation is going to continue to go down, interest rates are going to continue to follow that, I don't know that that's going to happen month over month, which is exactly why you might see a spike in interest rates pull back down, trading in a range, if you will, for the foreseeable future because of all of this volatility that we talked about in today's video. So if you're buying a house right now, just make sure you're buying for the right reasons, you have a longer term time horizon, you have money in the bank, and you're comfortable with the payment.